everyone. Thank you for joining our Smart Women Savvy Money group. We've got a very, very important topic that we're going to be discussing today. And for any of you who are coming into our app for the first time and you're wondering, why do we have that name? Because all women are smart. And I am the founder and CEO of Urban Wealth Management, UWM, and we have that Smart Women Savvy Money group. Our intention is to provide an essential knowledge base for all women so that they will feel confident and secure about establishing and learning about their financial lives. We have a great topic that we want to cover with you today. With so blessed to have PIMCO. We have Sonali Pierre, who will be speaking about this current stage that we are in now with higher rates, interest rates, and so being in fixed income and taking the best choices right now would be really, really important idea because of the fact that we will, in a few months, we're certainly going into next year, latter part of next year, which she will talk about, is that we will see a change in rates, and you will more than likely see an update in what what the value of your fixed income will be. So, what we want to cover, this is the fixed income opportunity and investing in today's market. We're very blessed in that we have today's speaker, Sonali here, is the managing director and portfolio manager in that Newport Beach office, which is a great area. I've been down there many, many times. They focus on their PIMCO, a multi-sector credit opportunity. She has over 20 years of investment experience and holds an undergraduate degree in economics from Princeton University. Prior to joining PIMCO in 2013, she was a senior credit trader at JP Morgan, trading cash, recovery, and credit default swaps across various sections. So Morningstar has named her as a winner of the 2021 U.S. Morningstar Award for Investing Excellence in the Rising Talent category. So we are so blessed to have Sonali Pierre as our speaker today. So with that said, Sonali, turning it over to you so that we can get started on this very, very important topic about the fixed income categories.
Thank you. And thank you, Renee and Smart Women, Savvy Money. I'm excited to be here.
We're happy to have you here. Yes. So just getting started, with a variety of certain very, very important questions and top Q&As. Can you provide a broad overview of fixed income markets today and how they have changed or evolved since 2008 through COVID and 2022 rising interest rates environments?
Sure. So, the fixed income market has actually nearly doubled since 2008 during that great financial crisis. It stood at about 28 trillion. Today is larger than 50 trillion. So we have a lot of opportunity here from which to select securities, asset classes, industries, you name it. There's a lot of opportunity to select which securities we think will outperform. Another key distinction between the post what we call GFC era, that great financial crisis time, is how much higher yields are today across the globe. So not just in the US, but broadly speaking, we've seen monetary policy pivot significantly over the last year and a half. In fact, during the post GFC era and during COVID, we saw long stretches of time with nearly zero or even negative yields. The global rate hiking cycle had pushed yields now much higher, but there was a point when we had 18 trillion of fixed income assets that with negative yields. Seems hard to believe today. In 2022, it was a tough year for all assets, whether it was equities, fixed income. When you have rates rising and credit spreads widening, that's an environment that's difficult for basically all asset classes. But on a look forward basis, we're pretty excited in 2023 and beyond that, the all-in yield environment today is certainly attractive from an income and yield perspective, but it's also attractive from a active portfolio management perspective, where we can select within asset classes, select within industries, select within a capital structure, really identifying the key security selection that can lead to alpha and better absolute returns. In credit, we've seen massive growth as well, especially in areas like bank loans and private credit. They both
Mm.
stand at about 1.5 trillion today and are now slightly larger than high yield, which is at 1.3 trillion. It used to be that the high yield 10 years ago was the largest of those three pretty significantly. So what that really means is there's more sources of funding for borrowers and more opportunities for lenders.
Yeah, very interesting. And I know that's going to be a point that we will bring up too, because a lot of people are like, what should I do with these banks right now? So, next question I have for you. What are the most appealing characteristics of fixed income securities today? And how does that compare with other asset classes or equities in particular?
Sure. So I think what's most compelling about fixed income today is its starting yield. Typically, the starting yield is a relatively strong indicator of forward returns. For example, today in the yield environment we're in, you can have a little bit of credit spread widening and still have positive absolute returns. So investors don't need to reach for yield. You're able to generate a pretty solid yield in resilient assets. And this leads to a higher risk return expectation looking forward. Importantly, also following a tough 2022 and a rapid rise in rates, fixed income is starting to exhibit more of its traditional characteristics, meaning lower correlation, a benefit from risk off with the duration. So when you think about where we are today in the cycle, with equities being up a significant amount, we're actually seeing some investors choose to de-risk, come into fixed income, and really get those long-term equity-like returns in fixed income with much better downside protection. In fact, I think we haven't seen this environment for a very long time where, it used to be that the risk-free rate and the dividend rate were pretty similar. So it was quite difficult for fixed income. Today, that's certainly not the case. And investors are certainly gravitating towards that incremental income that they're able to generate in the fixed income market with better resilience and downside protection than equities.
Yeah, hopefully so, because as we know back there in 2021, 2022, even if whatever fixed income, even, treasuries, federal treasury, they went down significantly in value. Many, many people were like, why is my account down? Why is my fixed income down? I said, just hold on to it. When it matures, you'll be fine. So this is really a great, great topic because we probably haven't been like these high rates since the 1980s, late 70s, early 80s. And so this will be a great time for people to really get up and step into this. So, how do we expect the current opportunity set to evolve over the next 6 to 18 months? What's your outlook?
Yeah, so I mean, we do believe that the bulk of the Fed rate hiking cycle is behind us. Likely, we may see in September one more rate hike of 25 basis points from the Fed. But
Mm.
overall, we have seen inflation come down, granted not yet at the Fed's target. Unemployment has been relatively sticky, and as a result, there's a possibility for quote unquote no landing, or at least an extension of when we enter a recession, meaning that time period going forward, having extended a bit, meaning a recession's not upon us over perhaps the next 6 months, but maybe by the end of next year. So we continue to kind of monitor where we may see more signs of kind of where the broader economy is going. But with dispersion, among credits to continue as a result of this uneven and uncertain environment, where there may be pockets of weakness over the next 1 to 2 years. Looking even further ahead over more of a secular horizon, you'll find on the site our secular outlook, which discusses, how the broader economy and marketplace may look over a 3 to 5 year period with the changes in monetary policy, less fiscal policy, and the diverging growth cycles across the globe, as well as rising geopolitical risks.
Okay. Wow. Very good to know. And but you do expect that the Feds will raise rates again here, probably the last time, because they've even said that a few times. This is the last time, and they did it again. Last time they did it again. So we're hoping that. And I know, which I've shared with a lot of people, inflation rate was 9% last year in June, and now we're down to about 3. So they're pushing it. So that's the positive side of having these high rates. And so we definitely want to make sure that everybody, as ladies, take advantage of these high rates because we probably aren't going to have this for a while. So, um, after this extension. So, how do we think about capitalizing on these opportunities across different fixed income asset classes, such as high yields, IG credit, securitized debt, government debt? Um, Give us an oversight about the fixed income sectors that we think that you think are more attractive than others on a risk adjusted basis. And are those risks for any given sector that we are cautious about or avoiding completely?
Yeah, so I think, we as investors, we need to be relatively flexible across that credit spectrum, right? We like areas within each of these sectors, but selectively. So meaning, again, that active approach of, certainly looking across at betas, but really selecting within them which securities will outperform. And as dispersion picks up, it becomes even more important to be active to find the ones that will continue to tighten and spread and outperform versus avoiding those, which may have black hole risk or underperform. So, again, being selective within these asset classes and thinking about risk factors, right? So, for example, in the mortgage market, we have interest rate risk, and essentially, when you own, say, an agency mortgage, you're selling volatility, right? Because it's correlated with the likelihood of investors prepaying on their mortgage or not. Risk factors like in investment grade and in high yield around the specific companies, or an EM around the specific countries. All look different, but may have some similar risk factors. For example, you may find oil beta in both the IG market, high yield market, and emerging markets through oil exporters and the quasi sovereigns that have oil and gas companies.
Mm.
So, when we look at, how to find the best risk adjusted returns, we have found currently that agency mortgages are quite attractive versus, say, treasuries. We haven't seen these valuations in 15 years, and in part because the Fed is finally stepping out of that market relative to the heavy footprint they had in the back half of 2020 and 2021, when rates were very low. Select areas of credit markets are also attractive. You don't necessarily need to extend down in quality to find a decent yield. So either a long-term hold for an investment grade company, or even, selectively within high yield, some of the stronger companies that we think could even become rising stars, meaning moving from high yield to investment grade. We also prefer developed markets over emerging markets. We prefer the US over Europe. And again, this is based on valuations and what we think the trajectory is of each of these markets. And then within the lower quality spectrum of credit, we do prefer high yield over bank loans and private credit, given the fundamentals are still pretty solid relatively, although we are seeing some spots weakening. But it's also has improved as an asset class over the last decade. So with all the growth in private credit and bank loans, you've also had an increase in risk to those areas, meaning the average quality of the bank loan market is a single B, whereas the average quality in the high yield market is actually a double B. And that has improved over time in high yield and deteriorated over time in bank loans. There's reasons for this, meaning the opportunistic nature of bank loans where you can prepay at par at any time has led to a lot of sponsor-led deals or highly levered deals, believing they'll grow into their capital structure over time. So they want that flexibility to prepay and end up in the loan market. There's other aspects as well, but overall, generically, we do prefer high yield over bank loans and private credit. But that said, we think there will be more opportunity on a go-forward basis in lower quality credit as investors become more selective, and we have the flexibility to say be on offense because we have some liquidity built while we're still invested. And I think that's one of the key points, right? Still being invested where interest rates are today, with where cash is today, meaning, I know Renee and I had talked about CDs earlier. Yes, you can lock in a decent level of rates for a short term amount of time, but with where fixed income valuations are, you can term that out and pick up incremental yield, but really but be able to know that you're going to get that steady stream of income over time. And that really changes the bar of, simply, investors often prefer to be 3 months late because it feels better as the market's improving to get in. But the reality is today's market is so compelling that you whether you're 3 months early, the question is just be invested, because this level of income can help really cushion any sort of slight spread widening or downturn, because the starting yield is attractive. So broadly speaking, we are picking our spots where we are relatively cautious, but we're more concerned about those who are not investing. Areas that we think will provide an opportunity further down the line would be some areas of real estate, some parts of bank loans, and some parts of private credit, meaning we're a little cautious that the valuation is not right yet, but will provide likely see some dislocation there and provide an opportunity in the future.
Wow, that is really, really significant. So, these areas that we're covering here. So, how should wealth clients or high net worth retail investors think about using either passive or active fixed income exposure? Can you briefly describe passive management and how that compares to active management?
Sure. So I think there's also a differentiation between equities and fixed income and what that means for active management.
Yeah.
Firstly, let me share that, I have been mentioning throughout this that dispersion has picked up. And when dispersion picks up, it really becomes an active manager's strong suit, right? Because their views have the opportunity to really translate into alpha. If everything's centered around the average and there's not a lot of movement, then the differences between active and passive diminish relatively. But in an environment with high uncertainty in terms of policy risks, in terms of geopolitical risks, diverging growth cycles across the globe, being active is so important in today's environment, especially with these higher yields and the flexibility to move across asset classes. So first, let me share that the market structure is one reason. So the bond market's large size and complexity, and meaning, you can have a secured bond in a structure, an unsecured bond, a subordinated bond before you get to the generic equity, right? So that complexity can be daunting for some market participants, but from an active portfolio manager's perspective, it's quite exciting in terms of trying to manage different goals and objectives. The other aspect that's different is index structure. Fixed income indices are constituted more often than equity, and the full replication is not always practical or cost effective. So the index designs may be suboptimal. What that means is, say, for example, at the end of every month, there's a rebalancing in a fixed income portfolio where if you invested in just investment grade and you have a fallen angel into high yield, that passive manager would have to sell it. And vice versa. If they're a high yield manager and it's a rising star and it goes to investment grade, they'd have to sell it because it's no longer in their index. Whereas we are able to, as active managers, really evaluate, is this valuation already reflecting the new asset class that it's a part of? Or do we still think that there should be some catch up exercise, in which case we'll continue to hold? And often overshoots are found in these types of rating change moments, or when there's M&A, or when there's an asset sale. Who would be the most likely buyer of, say, a high yield asset sale? It might be an investment grade buyer. We have 80 plus credit research analysts that we are so grateful to have those boots on the ground, really, communicating with management teams, understanding what the drivers are of these businesses, and then trying to help shape the covenants that really protect our investments. And the reason that's so important is because if they're set up across an industry, they really understand, what are the drivers of that industry, and then which are the strong companies, the weak companies, and what's the possibility of their next steps. So again, highlighting that credit selection, industry selection, and then even down to which tranche within the specific credit do you want that exposure in. And then the last piece I'll mention is investor segmentation, as we kind of mentioned already around, the reliance of a certain asset class. But even with active management, I'm a large advocate of multi-sector credit investing because of the fact that you're not beholden to any sort of single investor segmentation, index structure, market structure issue. That really, there can be some structural tilts of where you think there's value in the broader fixed income marketplace, but there can also be that tactical bend of when you see value or an overshoot, you can pivot. So an example of that would be, in December of 2018, we had this liquidity crunch where bank loans sold off materially. So much so that we were able to sell high yield unsecured bonds, move up in the capital structure into a secured loan, and not give up spread, just because there were others who really needed that liquidity. And we had the flexibility in the style that we manage, the liquidity, and the ability to kind of be tactical and have that dry powder to be the price setter at those times, as opposed to needing that liquidity and being a price taker. So at PIMCO, we see these characteristics as an opportunity to strategically navigate fixed income markets with an active investment approach.
Wow. Well, yeah, that was what my next set of questions is to talk about PIMCO, which is a very active fixed income manager. So, how does PIMCO facilitate the ability to manage across fixed income sectors according to your top down macro views and bottom up credit research?
Sure. So, we are often known for the thought leadership from our macro process that comes from our
Mhm.
global advisory board that's has some very impressive, renowned economists and strategic thinkers. It also comes from our investment committee, which, unlike many other investment committees, we meet 4 times a week, 2 hours a day. It also comes from our forum process. So every quarter, the whole portfolio management team and sometimes the broader firm, depending on the day of the forum process. So meaning if it's a macro day or we're going into the strategies for each of the asset classes, will come together and share what they think are scalable trades, trends in each of these asset classes. And that gives us a chance to really evaluate where we think we are in a certain cycle, what asset class expresses our views the best, and where there's risks to be aware of. So all of that top-down process is married with the bottoms up. I mentioned earlier we had 80 plus credit research analysts that are
Mm.
across the globe and in various industries looking for that bottoms up opportunity to uncover, which security will outperform within the capital structure, within the industry, and then of course provide that alpha. So for example, part of this is also being in a large, well-resourced firm. That breadth of the depth of the PIMCO platform really gets unlocked when, for example, when we see large opportunities like, the non-agency market after the great financial crisis, or pairing together our mortgage analysts during peak COVID with our credit research analyst for a company that, struggling retailer, where typically it's a sector we have had been underweight, but one where, our mortgage analyst was able to evaluate the collateral value. Our corporate credit analyst was able to evaluate the credits prospects. And together we could come up with a secured issuance where it's a solution for the company. It provides downside protection because we had collateral to the real estate value, and upside convexity still with stores potentially reopening and traffic coming back into brick and mortar stores to lead to a potential spread tightening. So, at the end of the day, where we stand in showing how, our approach, we're going to navigate across different economic environments, across asset classes, and we really feel this active approach, specifically in fixed income, is attractive for our investors and potential investors.
Yeah, exactly. So, utilizing PIMCO's macro views and credit research in a way that has benefited returns in the past. What are your thoughts about that? What is it going to be in the future? And can you designate what specific areas in the fixed income um, do you think would be best, including on an international level? Do you all have some thoughts about being in the international outside the US?
Certainly. So, marrying the top down and the bottoms up is really what I would call one of the hallmark edges of the PIMCO process, where we have a lot of thought leadership from the top that helps skew perhaps the bottoms up, right? So, meaning there's no substitution to the bottoms up work. You got to know the security, the flexibility within the capital structure due to the covenants, where this company is going, whether it's from an ESG perspective and the like. However, whether or not to even be in that industry may be informed from some of the top-down views. So, for example, our commodities analysts interacting with our oil and gas research company analysts, or our mortgage specialists interacting with our credit research analyst in home construction and in building materials. So you can see kind of how that top-down influence is certainly important to judge the forest from the trees, right? So should we even be in this sector? And then within that, which companies will be overweight, market weight, and underweight. In terms of, where we are in fixed income and where we're seeing value, I would say we're seeing value in some high quality credit spread sectors. So that's agency mortgages, investment grade for a longer term hold. So meaning acknowledging there could be some volatility along the way, and some parts of the high yield market as well. In terms of, across the globe, we do have a preference for developed markets currently over emerging markets. But part of that has to do with where we are in the hiking cycle and the impacts thereafter, right? So, meaning the consumer here in the US and the corporate fundamentals are relatively strong, that are certainly helping overall that view. But that's not to say that these are all areas in which we're constantly evaluating the fundamentals, the technicals, and the valuations to see if we have a shift in views and moving towards that, right? So these are not static views. These are certainly ones that are evolving alongside a ever evolving investment landscape as well.
Right, great. Um, and so, uh, just a couple of last questions. Given the timeline that we're in right now, and the expectation that there will be a shift, a change in rates, what is you all's thoughts about when we will see that change to take place, where we will see interest rates start to go down? Do you expect it in a year, 2 years? What are your thoughts about when that, and of course, anybody who has these fixed income issues, they're not going to be negatively impacted if we see rates go down. What is the timeline that you see that
Right. Being
happen?
invested in fixed income and then having rates go down is obviously a benefit to these
Yes.
types of securities. So, our base case is that, um, we do think that the market has priced in more cuts than we are likely to see. So, if you look at the forward rate implication of where, what Fed policy will be, while the Fed is saying, that there's no rates cuts on the horizon, I think part of that is to ensure the effectiveness of their hikes and the current policy. Nonetheless, our base case is that we're more likely than not to potentially see a recession, but not maybe one that starts until the end of 2024. And so, that while we think that there will be less cuts that are priced in versus what's priced in the market, it's still possible to see cuts by the end of 2024.
Okay. So we're looking at definitely, let's say it's a year. So it gives people time to really step up and start investing and getting more aggressive about being in fixed income. So that's good to know. Good. And making sure that we make the appropriate steps. And I know you all have a bunch of mutual funds. You also have some ETF, or you will be coming up with some ETFs.
That's right. So we have some active ETFs and certainly have a wide variety of mutual funds, all of which can be found on the PIMCO website.
Being in fixed income right now and knowing this space, this very, very important topic, this is very timely that you need to reach out to us so we can get you into PIMCO. So, with that said, thank you very much for your time listening in on this very much, Sonali. Appreciate your input because I know you are super busy, and the fact that you were able to be here with us to have this conversation. And we appreciate all of your input, your thoughts, your ideas, and being able to communicate that to all of our smart women because they're going to get smarter based on this.